Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome back to our weekly podcast Through the Noise. My name is Fook Hien. I'm a senior investment strategist with the Standard Chartered CIO office, and I will be your host for today. Joining me today is Ray, our senior investment strategist, to help unpack market events and talk about positioning and where opportunities might lie. Hi Ray. This past week, US CPI data seems to be softer than market expected. Does that bring any changes to our expectations of a rate cut in the US and also our views on the US government bonds and fixed income in general?
Thanks, Fook Hien, for having me today. In fact, we think the peak hawkishness from the Fed is likely behind us following the release of a soft June CPI inflation print. In that, the headline CPI inflation actually fell 0.4% month on month. It's actually the biggest monthly drop in years. And this has supported the view that the rise in inflation over the quarter two this year indeed was likely a temporary surge led by oil prices alone rather than being a more broad-based risk. Now, the data point also reinforces our view that the Fed is likely to leave rates unchanged through the remainder of the year, and the so-called peak hawkishness is likely behind us. However, the relief was more visible in shorter-term US dollar bonds, let's say using the 2 years as a benchmark, relative to the long-term bond yields, which we are using 10-year as an example here, suggesting that the long-term fiscal concern remains there. Now, meanwhile, tension in the Middle East rises again this week following attacks on ships transiting through the Strait of Hormuz. The U.S. initiated new military strikes on Iran, which in turn retaliated across what it called U.S. military locations. Now, as a consequence of that, oil prices moved higher to currently around $85 per barrel and closing to the upper end of our expected 70 to 90 barrel per US dollar per barrel range. While there's a risk that Trump will follow through on his threat to escalate the situation further, we believe the U.S. side will have more incentive to avoid a larger oil price shock given the risk to the U.S. growth and also the upcoming midterm elections. So that means to us, any temporary oil price spike above the $90 per barrel mark are likely to be unsustainable and not for long. So near term, we see the 2 years US Treasury yield to continue to trade within our target range of 4 to 4.25%. While the 10-year has broken our near-term range on the upside, we expect it to be range trading around 4.5% to 4.65% until further significant events that can drive oil prices either direction. Now, with a view that we have likely passed the peak hawkishness, we think it is also an opportunity now to lock in yields with the recent rise in the bond yields. And we maintain a broad preference for credit over government bonds with an overweight on EM US dollar government bonds. However, we continue to favor short maturity to avoid excessive exposure to volatility triggered by any new any inflation or fiscal worries. In addition, we continue to see TIPS as an attractive hedge against a more adverse scenario on inflation.
Okay, thanks for that, Ray. Let's change the geolocation to the UK. There's going to be a change in the Prime Minister in the UK, with Andy Burnham to assume the role next week. Now, will this spark heightened volatility in the pound or the GBP and also the UK gilt yields?
Thanks for Hien again. In short, we do expect gilt yields and the pound to remain range-bound in the near term until there is a greater clarity on Burnham's policy agenda. Yes, Andy Burnham is actually expected to become the Prime Minister next Monday after he has already secured the backing of a majority of the Labour MPs. We can see why the gilt markets to be anxious about this appointment, as Burnham's fiscal vision is more left-leaning than Starmer's. In fact, if we use the 10-year gilt as an example, yields have risen by about 30 basis points since Burnham emerged as a strong contender in late June. However, Burnham seems to try taming the market with some comments to show that he will have some fiscal discipline in mind. He has publicly mentioned that he won't be looking to change Rachel Reeves' self-imposed borrowing limits for the UK government, while he's also open to the idea of reducing the welfare bill. And yet the market will likely remain concerned about how Burnham may seek flexibility within the fiscal rules, and he has also reportedly considering bringing forward a blockbuster budget later in 2026, which include the potential to add an additional 40 billion sterling to fund infrastructure and housing investment, alongside the removal of defense spending from the existing fiscal rules. But perhaps the more worrying for the markets were his comments that the UK has to move beyond being in hook to bond markets, which contributed to the initial spike in yield when he entered the PM race. But on the balance, we think gilt markets have already embedded a meaningful near-term political risk premium, and we expect them to remain range-bound for now as investors await the autumn budget and the Parliament's now entering its summer recess, which is lasting until September. Now, whether Rachel Reeves will retain her position in the cabinet will also be closely monitored as a signal of the government's continuity in fiscal policy, and the choice of this position will be a key factor, also impacting the pound sterling. Potential policy that promote investment and growth while respecting fiscal constraint would be broadly neutral to positive for the pound. But on the other hand, unfunded spending commitments or perceived weakening of fiscal discipline are likely to revive concern over UK debt sustainability, which will weigh on the pound sterling. Our base case right now is a brief increase in pound volatility rather than a sustained directional move. The pair pound-US dollar is likely remain more sensitive to the dollar, and we think factors like the US rate expectation, upcoming UK fiscal announcements will be more impacting than Burnham's actual appointment.
Okay, thanks for that. And moving to equities, what is our expectations towards the upcoming tech sector's earnings? And also for the US banks' earnings, what have we learned so far?
Now, we actually believe earnings growth in the semiconductor sector will remain strong with good visibility. And we want to reiterate that we favor diversifying exposure into Taiwan equities. We do expect US hyperscalers to deliver strong earnings growth and prefer gaining exposure through the US communication services sector. The earnings reports from the semiconductor equipment industry will point to unprecedented long-term visibility for us, and we see sustained AI-driven demand across both advanced logic and memory chips, and it is giving chip makers the confidence to accelerate capacity expansion plan. So Taiwan equity's significant exposure to the semiconductor industry makes them a very preferred route for gaining exposure to this attractive growth in our view. As for the US hyperscalers, we expect solid result driven by cloud growth supported by robust AI adoption and healthy digital advertising trends. And the market is likely to focus on whether hyperscalers' significant AI investments are beginning to generate meaningful returns. We will also pay attention particularly to the management commentary on AI monetization regarding new revenue stream through enterprise subscription, AI model usage growth, and consumption-based pricing trends. We also expect hyperscaler to maintain elevated AI capex spending. In addition to diversifying into the Taiwan semi-sector, we see the U.S. communication service sector, which is dominated by large internet platforms with reasonable valuation, as an attractive opportunistic trade idea. Now, as for the U.S. banks, the major U.S. bank delivers significant earnings and revenue beats in the Q2 earnings versus consensus. That is driven by a surge in fees from equity trading and as well as in investment banking activities. Market volatility, AI-related capital markets activities, and mega listings such as the SpaceX IPO supported this growth. Meanwhile, resilient U.S. consumers supported the stable credit quality for the banks. Going forward, we think growth shall be supported by a healthy pipeline of equity underwriting and M&A advisory fees. And an elevated equity markets also bolster fee income for the asset management business. Bank earnings guidance now was broadly raised, although management flagged tougher second half comparison and sounded a little bit more cautious tone around the macro uncertainty, inflation risks, and also big fiscal deficit. But valuation for major banks are elevated, yes justified, making them very attractive to add on pullbacks.
Okay, thank you, Ray. So in today's session, we discovered how softer inflation data supports our view that the Fed will keep rates on hold for the rest of the year. Oil prices are a risk to inflation, but unlikely to see a sustained rise. And in the UK, we expect gilt yields and the pound to be range-bound near-term until we have greater clarity on Burnham's agenda. And with the earnings season, we continue to like semiconductors exposure, which you can get from Taiwan equities. And we like US communication services for the internet companies. And US major banks' results have beaten expectations with good growth prospects. That brings us to the end of today's episode of Through the Noise. Thank you again, Ray. And thank you to all our listeners for joining us. We look forward to having you with us again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.